Hello and welcome to the Mutual Fund Show. I'm Niraj Shah. The next 25 minutes, 20 odd minutes, we'll talk about a couple of key aspects related to current investing, and then something that will start this week and continue for every week. Try and bring in one explainer towards the end. So we're going to be talking about, with yields shooting up across the world and likely in India too, and likely to maybe move up further, if that is the hypothesis. What is the kind of adjustments you need to make to your portfolio, mutual fund portfolio? That's the first question that we get both our experts to answer. We will ask them about whether there is a need to differentiate between gold ETFs and silver ETFs, and if so, what is it that they prefer and why? Lastly, a lot of us would not know why is it or how is it that the NAV that gets reflected in your statement moves. It's a very basic question, but if you don't know, I think we'll try and ask our experts to try and explain how would the NAV of a fund move, and when would it move higher, or when would it move lower? Would it necessarily move in conjunction with the market moves, or could it be different? All of those questions answered by both our experts. Both of them have been on the show before. Nisreen Mamaji, CEO of MoneyWorks, as well as Tarun Birani, founder and director of TBNG Capital Advisors. Both of you, thank you so much for joining in. Really appreciate your time. Nisreen, ladies first, let's start off with you. I'm not a sexist, by the way, but let's start off with you. The first question, with yields moving up, everybody who's investing in equities know that, okay, that could be a cause for concern. Right. Since mutual fund investors also have the option of using debt products, and in a rising yield scenario, both of them might get impacted. What is the judicious mix of equity plus debt portfolios? What are the changes that you believe people should make to their portfolios if the hypothesis is that yields will either stay at these levels or move higher as the year goes by?
Sure. So thanks for that question, Niraj, and thanks for the introduction as well. So typically, the financial planning rule is that if you are in your 20s to 50s, you would typically have a higher range, and in your asset allocation, the portion towards equities would be higher. And if you are in the retirement phase or, approaching retirement, then you would slowly convert that into, fixed income or debt. Now, having said that, every time you rebalance the portfolio when the yields go up and the equity yields go down, and you are not sure when to re-enter the market, right? Because that's also a question. So statistics has proved that when you do this, when you try to do the market timing, it's not always worked in your favor, because you might have just stayed in cash for a long period of time, or you might have even used that money, gone on a holiday, seen that balances in your bank account and actually spend the money. If you can withstand the volatility and the ups as well as the lows, then the best thing to do for your longer term investments, which could be retirement or buying a home or children's education, is to stay invested and not really look at the yields. But having said that, a lot of us, investors are also very panicky when the markets move up and down. In that case, a dynamic asset allocation fund is an ideal instrument for you, where the fund manager himself or herself will switch between bonds, equity, as well as gold or international equities in a lot of multi-asset funds or in a lot of dynamic asset allocation funds. So if you don't want to do it yourself and rebalance your portfolio every time the market has moved up, which is what is happening right now, where you should be possibly selling equities and buying more of bonds, and the other way down when the cycle moves is to just stay invested in a dynamic asset allocation fund. But if your goals are further away, ignore all this, ignore the noise, and just stay invested. I think that would be my view on this, on the movement.
Okay, I'll have a follow-up, but before that, Tarun, initial update from you, and what's your sense of what is it that investors should do?
Right. So thank you, Niraj. A couple of pointers right now in the environment where we are in. So I'll give a brief update on the fixed income side also, right? The budget has come in and we have seen the yields have shot up after that on the longer side, as well as we are seeing pressure on the shorter end also. So in this environment, currently it's a very very volatile environment, at least on the fixed income side also. And one need to be extremely cautious in terms of investing in fixed income right now. So in that space, there are three different spaces. One is a 1 to 3 year, 4 to 6 year, and 8 to 14 years. Okay, so out of this 8 to 14 years or the longer end, I feel the government borrowing program looks very heavy. So due to that, I would strongly recommend currently not to enter into that space, to completely avoid that space, because it could be very volatile. We are at 680 10-year kind of environment right now. It can quickly move up right now. So that should be avoided. 4 to 6 looks a very interesting space where the YTMs are close to 625 to 630. That is a very interesting space, and I feel a rundown maturity kind of products can be looked at in that space. And in 1 to 3 year also, my suggestion would be one should only look at a arbitrage or a overnight or a ultra short term category, not to venture, because this also could be very volatile going forward. So investor need to, this is like your seat belts need to be tight right now. I think next 1 year is going to be extremely volatile in terms of fixed income, because the inflation, I'll not go in that detailed version, but the global, domestic, everywhere we are seeing the hawkish moves are coming, and due to that the interest rates are going to be volatile. So one need to be careful there. Talking about the equity mix, I feel there are two approaches. From a financial planning approach, the suitability or your long-term planning is what should take over. And in that, your debt equity levels should be decided based on your suitability and your long-term goals. Keeping that in mind, one important update right now. So currently, as the equity markets have given phenomenal return in last 2 years, what one can look at is a rebalancing, and rebalancing is extremely critical right now. So small and mid cap as a category works. Basically, these are high beta assets. So in these environment where we are in right now, my suggestion is to cut all the high beta assets. The small and mid cap portfolio need to be reduced or trimmed right now, and that money need to come into cash. That's the tactical part of the portfolio. That's what we are currently recommending. And the blue chips or the long term, what you have built in for your long term goals, I think they can continue to remain as they are. But small and mid cap is where one need to be extremely careful, because in this volatile times, all the asset which has moved because of this favor of this fiscal stimulus, all this will come at an elevator space. They have gone as at a staircase, but they will come at an elevator phase. So one need to be very careful there. Yeah.
Okay. So viewers understand Tarun is taking a call here that for his maybe clients, he's reducing their small and mid cap exposure because they're taking a hypothesis for clients who might get bothered by the volatility to get out of small and mid cap stocks and maybe enter into cash or the other space. What Nisreen was saying, that if you are a passive investor and if you have a really long-term vision, then don't try and alter too much, because you will not be able to time. And if you indeed believe in timing, then maybe the dynamic asset allocation funds could be an option. Nisreen, just one very quick follow-up for people who have existing products in the, typically retail clients have it in the fixed income side, exposure to, between 3 months to 36 months, right? Nobody kind of really parks in money. At least the people who talk to us or write to us don't park money in fixed income for 10 years. So for that period, if the presumption is rising yields, should there be changes made to the portfolio?
So that again is, why have you invested in the fixed income in the first place? So those could also be moved to, say, a floater fund, which is what we did anyway about 6 months to 1 year back, having predicted that, the interest rates will be moving up in the next couple of years, and, assuming that that's going to happen. Typically, if you are, just parking your instrument, money, you need just a parking instrument, so say for 1 to 3 months, because possibly you're buying a house or a property, or, you need the money to put down for certain goals, then you just stay invested. There are a lot of people who are in medium-term plans, in the 1 to 3 year range, and having discussed with them and informed them that this, movement might take place. Also having discussed with the fund managers themselves as to how they are handling the roll down and the, tenure of those funds. At this point of time, we have not recommended any changes or any switches, because also having a tax implication and keeping in mind what is the current status of even the 1 to 3 year funds, So we have decided to stay put.
Okay,
and
one quick
suddenly make sudden changes. Yeah, go ahead.
Got it. One quick 30-second question to both of you before we move on to the next topic. Tarun, to you, a lot of people park money in liquid funds. They were advocated as big proxies of fixed deposits in a rising rate scenario for people who might have near-term need. And it's not predictable whether they need the money in 3 months or whether they need the money in 5 months or 1 month. Are liquid funds still the best option or a better option, or are there other options?
So as I started my analysis on the fixed income side, currently the money which is a 3-month kind of money, my suggestion would be to keep it in an overnight fund versus a liquid fund, because you could see in the short term a lot of volatility to come in due to the interest rate changes. And arbitrage also is a one preferred category because of the tax advantages, as well as the firm up of the yields in the arbitrage side also. So there also I see better allocations.
Got it. Nisreen, does your view differ?
No, the same actually. Arbitrage definitely, because the spreads are very comfortable right now. So that is a category that we are considering, plus the tax benefit. And for people, as the overnight funds or the ultra short and low duration, and actually the YTMs are very, very low. So I would prefer the floating rate in that scenario, or the alternative is arbitrage.
Okay. I don't know if you guys have preferences, but viewers, at least as per my understanding and whatever guests have in the past said, in arbitrage funds, most funds kind of cut the cloth reasonably okay. So you can pick and choose whichever fund house you want to go to on the arbitrage fund. Tarun, Nisreen, I presume that's the right answer, or do you have some recommendations?
Absolutely. No. I think in arbitrage is not really many choices to be made. So you can just go ahead and, because the spreads are equal to all the fund managers. So just take your pick. It's fine, whatever you are comfortable with.
Correct.
Got it. Okay. Tarun, the next topic, I want to start with you. Silver ETFs versus gold ETFs. We've seen 2 or 3, if I'm not wrong, silver ETFs. They didn't mop up too much money. Mopped up a little. I think the ICICI Pru offering mopped up a little over 100 crores, if I'm not wrong. But they are here now. The question is, should one choose one over the other? Why or why not?
Right. So let's understand these inflation. The gold and silver are basically inflation hedge kind of asset, right? And both of them, and we are seeing an environment wherein the inflations are rising, and you could see both of them can help as a cushion against this entire hawkish or inflationary trend which we are seeing right now. Okay, so from that perspective, yes, these assets could be looked at. Again, we need to understand from both these asset perspective. From a usage point of view, gold is normally more from a jewelry point of view. Silver is used from a industrial use also. Due to that, the volatility is much higher in the silver part. Again, from a correlation point of view, gold has a very low correlation with equity, but silver has a better correlation with the equity. So from that point of view, if one is looking at diversification as a per se as an objective, gold continues to be a preferred asset because it has a low correlation with the equity. But one can look at a combination of a gold and silver from that point of view. And again, return point of view, both the assets from a last 5-year view, if I look at, the returns have been between 7 to 9% CAGR on an overall basis. So one can look at a combination, but I would be a little more cautious. I want to see how this silver ETF or the index for 6 months, 1 year, to see how the systematic changes, because it's a new asset class in the Indian environment. So I want to see how it pans out, and then maybe one can look at investing into this.
Yeah. Nisreen, what are your thoughts?
Basically, silver's fortune is more linked to the economic cycle because of the higher industrial use. So, for example, silver, if you look at where is silver used, the allocation towards industrial is nearly 50.7%. Towards jewelry is only 17.8%. Silverware is only 4.2%. So basically, the bulk comes from the industrial use, which could be, right now in the recent budget also, we've seen the electric vehicles. So electric vehicles and the automation industry is poised to move at nearly 22% CAGR over the 2021 to 25. So there is a use for silver. For solar energy, there is a use for silver. For 5G rollout also, again, in the recent budget, there will be silver is used for semiconductors, for cables, for chips, for fuses. Photography has about 2.8%. So if you consider the bulk of silver use, it is towards industrial, while 80% of gold is only towards jewelry. So, going forwards, the industrial demand will pick up. And therefore, of course, there is a role for the silver and silver ETFs. Secondly, when the economies take up, for example, gold will rise higher than, silver will rise higher than gold. So when inflation is on the rise, silver will go higher than gold because silver is considered to be a slightly, better inflation than hedge compared to gold. On the demand supply side, again, silver prices are more responsive than gold, because gold is more, most of the foreign government, central governments and pension funds and, the large institutional investors will hold gold, large reserves of gold. Therefore, that lends to, stability for gold prices, but it is not affected by the economic decisions. So silver also has a very weak positive correlation to stocks, bonds, commodities, and therefore, as a diversifier, gold would be a good instrument to keep. So, keeping both these views in mind, in the longer term, if industrial use is going to pick up for silver, then definitely we should keep an open mind and, also introduce some amount of silver, either in a multi-asset form or in a ETF form, vis-a-vis gold, which has been our traditional instrument for hedging.
Okay, so you are essentially taking a call on silver as a commodity, and therefore you're using silver ETFs to increase the exposure of silver in the portfolio.
Right.
Got it. And Tarun, you are just wanting for the next 6 months to go by to see how the product performs or ETFs perform because they're a new category, and then take a call.
Sure. Yes.
I get your point. Okay. Thank you, both of you. The final point, Nisreen, I'll start with you on this one. And the basic of how NAV of a fund is calculated and what should because I think a lot of people want to invest in a new fund offer because the view is like, oh, the NAV is only 10 rupees. So let me go and invest there versus some existing fund, but in the NAV might be 120 or 230 or what have you. So how is that? What is the NAV of the fund? How does it come about and how does it move?
So, very typically the NAV stands for the net asset value. And the calculation is done by the cash and securities held by that fund minus the liabilities divided by the number of units outstanding. Okay, so that's the formula for how the net asset value is calculated. Now, every day you'll see that your NAV has gone up or gone down. That's because the stocks or the securities, the bonds or the cash component has possibly gone up, but the number of units outstanding has remained the same. So if you're looking at an equity mutual fund, possibly the portfolio is because the shares of that equity mutual fund has gone up simply because of demand or supply, some economic news, monetary, there could be various reasons why a particular stock of a company goes up. In a mutual fund, you'll have a range. In a diversified equity mutual fund, you'll have 50 to 60 stocks. So it may not move in tandem with the Sensex or an index, but at the same time, there will be certain, some news, pandemic or some industry related news, some sector related news, which has an effect to that particular fund. Now you'll have thematic funds, you have sectoral funds, you'll have a pharma fund, you'll have an IT fund, or you'll simply have a diversified equity fund. In the bonds, the same situation will arise. In a fixed income fund, there will be, various categories of bonds. So the same logic will apply to the fixed income part of the bond. So that is how the NAV will go up and down depending on the price of the cash and securities of that fund minus liabilities divided by the number of units outstanding. It's a very, I hope the answer has been simple enough.
Yes, indeed. Tarun, and thanks, Nisreen, for giving that. That's essentially, viewers, the crux of it. Tarun, you want to come in? Again, the question on the NAV and the behavioral aspect of how people tend to choose at times, or not necessarily everybody, but a few people tend to choose an NFO. One of the reasons was, it's the NAV is just 10 rupees and not very high.
Interesting question, Niraj. I think NAV is nothing, mutual fund is nothing but lakhs of investor pool in their money and they invest into an instrument, right? And the fund manager takes care of that. And I think Nisreen has taken care of that question very well, how the NAV is done. I'll take the behavior part of it, and I would strongly recommend go by the 4 P's: performance, pricing, as well as process, as well as the pedigree of that fund house while selecting a fund house, not to go by the NAV, because NAV is a very deceptive tool to analyze whether the fund is a good one or bad one to pick up, right? It is not like a stock. If it is at less price, it will give you better return. Again, in stock also it doesn't work, but in a mutual fund also one need to be careful from a pedigree point of view that those 4 P's are more important while selecting, and investors should avoid that NAV checking on a regular basis to make their decision to invest into a fund. and it should only be driven by the strong fundamentals or your clarity about that fund house. Then only you should pick that up.
Got it. Well, I think this was succinct enough, and we wanted to keep it that way in order to make you understand a quick glimpse of the NAV and the fault lines that revolve around making decisions based on the level of the NAV. Yes, the NAV should be on an upward trajectory for you to make money, but a lower NAV does not mean that you're getting the fund at a bargain. Please keep that at the back of your mind. Tarun, Nisreen, thank you so much, both of you, for joining me today on the Mutual Fund Show. Really appreciate your time.
Thank you so much. Thank you, Niraj. Thank you, Nisreen. Bye.
And viewers, thanks for tuning into this leg of the Mutual Fund Show.
Thank you.
Thanks, Niraj. Thanks, Tarun. Bye.